Hello and welcome to Portfolio Matters Weekly Market Checklist Week 216. And as Richard is on holiday, Stuart Owen is here to talk about Japan. But before we get into it, he will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions for topics mentioned on the show. There's a full disclaimer at the end. So, what do we have, Keith?
Well, as usual, we have a lot because the world is not calming down. So, first of all, the news. Well, Iran held a funeral for Ayatollah Ali Khamenei, who was killed by a US airstrike during the recent slash ongoing war, together with his daughter, daughter-in-law, son-in-law, and granddaughter, all killed at the same time. Now, we obviously are allies of America, but if it was the other way round and we had started peace negotiations and then the opponents had bombed our leader, killing his entire family, I don't think we'd be very chuffed, and I don't think we'd be considering that fair play. So Iran is filled with righteous fury about this, and I do not expect them to be calming down anytime soon. The war in with Iran seems to be very much back on. So Iran earlier in the week or last week attacked shipping attempting to bypass the PGSA controlled northern route. US then declared an end of the ceasefire and attacked military and infrastructure targets in Iran. And Iran then issued a statement saying that the Straits will be closed for the foreseeable future. US insists that the Straits remain open. Donald Trump calls the Iranians scum. It's all going very well. Tit for tat strikes continued over the weekend, and last night oil is up again this morning. And hurrah, this is something we predicted correctly. For once, saying that we didn't think the war was over and that Iran would attempt to control the Straits. More on that later. Elsewhere, Donald Trump has received some setbacks in US courts. Notably, the Supreme Court prevented him sacking Fed Governor Lisa Cook, although it did approve his general ability to remove heads of US government departments, just not the Fed. The US has declared that the USMCA, the US Mexico Canada agreement, trade agreement, will not be renewed next year and instead will have to be renegotiated every year. Donald Trump continues his war on trade. He has declared earnings of 1.4 billion in 2025, mainly from crypto. So he's successfully monetizing the White House. And Germany is doing fiscal stimulus on quite a large scale and borrow 800 billion over the next 4 years to fund a rearmament drive. Some charts related to the news. Well, this has not been updated since the ceasefire broke down late last week. But prior to that, falling oil prices had an extraordinary positive effect on inflation expectations in the US, which were collapsing. Brent is sadly for international markets, though, not for oil investors, back up, and that will be bad for inflation expectations. So this is the impact of the USMCA, and you'll see that it has been very good for Mexican trade with the US. Trump's attacks on Canada have an imposition of tariffs on Canada have been bad for Canadian trade. Tariffs have also succeeded in cutting Chinese exports to the US. So we've got a big section coming up on Japan, and the yen has been weakening ever since the new government of Sanai Takaichi has come in, and it is approaching the key level of 165. Now, the Bank of Japan has been intervening in April and May. Will it start intervening again? That trend seems firmly upwards. More on that later. Now, also supporting the oil price is renewed attacks by Ukraine on Russian oil infrastructure, which seem to be increasingly effective. So this week, Ukraine attacked oil tankers in the Straits of Azov. It attacked 9 small tankers in one day, and it's also been attacking refineries close to Ukraine, actually, including several hundred miles into Russia, to the extent that Russia has now banned diesel exports to protect domestic supplies and is rationing them. You'll notice we've had a heat wave. This is the trend in global temperatures. We are now over 1.5 degrees higher than pre-industrial levels, and that trend seems firmly up. Best get used to it. And this is Donald Trump's earnings last year. Pause, take a look. Not very edifying in my books.
And that doesn't include the profits from all his stock trading. I mean, he's doing thousands of trades, and of course, they're all happening just before announcements from the White House. I mean,
Yeah.
the decline of the U.S. Republic is shocking.
Well, it's the fact that they had a huge go at Hunter Biden for what was corruption, but frankly, tiny corruption compared to the billions that Trump is making. Anyway, on to war news. So the ceasefire is over. Pause have a read, but essentially the war is back on, and Iran is attempting to assert its control over the Straits of Hormuz. The US is saying the straits are open when they're clearly not, and is bombing Iranian military sites. One side will eventually assert control. We expect it to continue until then. Now, so the problems are arising from the Memorandum of Understanding and different sides' interpretations of that. So the Memorandum of Understanding in point 5 says the Islamic Republic of Iran will conduct dialogue with the Sultanate of Oman to define the future administration and maritime services in the Strait of Hormuz, i.e., Iran thinks the Memorandum of Understanding gave it the ability to manage the straits, and clearly the US doesn't, hence conflict. Also, the US has placed the Persian Gulf Strategic Authority, the Iranian entity charged with managing the straits, under sanctions. So if any Western companies attempt to pay the Iranians, they risk being in violation of US sanctions and then face being locked out of the dollar financial system, etc., etc. So that is a very good way of bunging up the straits. So what is Iran up to? So last week, Donald Trump, after saying that the Iranians were scum, also went on to say the Iranians were desperate for a deal and negotiations were ongoing, and the attacks by the Iranians on shipping in the Straits of Hormuz were by hardliners who were not really being controlled by the government, and the moderate negotiators were denying their responsibility for the attacks. So, what is going on here is that the negotiators are attempting to preserve dialogue with the Americans and avoiding full scale war, well, by playing up internal tensions within the regime. And how true is that? It is likely that both the moderates and the hardliners agree on the key strategic objective of um, gaining control of the Straits of Hormuz, although they may disagree on tactics. So the negotiators are using the hardliners as part of their negotiating tactics, saying that they're not really in control of the hardliners, which allows them to continue attacking shipping in the straits while eschewing responsibility for that. Expect that to continue. Reminder, Iran is attempting to get all the traffic to go through its territorial waters in this northern route, whereas the US has been sneaking traffic through this southern route close to Oman, and Iran has essentially been attacking traffic going through that US route. Okay, so status report on where we are, the latest in the Gulf. So, having surged, the traffic going through the straits, and most of it's been escaping, very little has been going back in, has collapsed again. And this is a more granular um, view of what's been going on. And latest data as of 3 days ago, traffic collapsing once again. And the important point is most of this is traffic which was trapped in the Gulf and has now escaped the Straits. In order for full flows to resume, you need empty tankers to go back in, fill up, and come out again. Now, very few empty tankers have been going in. So this is sort of a one-off surge in oil escaping from the Gulf. Meanwhile, a lot of oil wells have been shut down because the oil can't get out of the Gulf, and there has been no increase in oil production in the Middle East because of the temporary reopening of the Strait. Diesel prices are rising again. Gasoline prices not rising so much, but not falling either. Propane prices, which are mainly a function of natural gas, have fallen back to normal levels. Jet fuel prices rising again, but not excessively so. Diesel crack spreads show that the problem is not crude supply, it's refinery availability. Reminder, there are big refineries in the Gulf which can't get their refined products and diesel and gasoline out. But a lot of oil has escaped from the straits during that temporary opening, and that means that global oil on water, so the amount of oil in transit in tankers, is back to close to all-time highs. So there's a surge of oil supply will hit global markets over the course of the next 2 months as those tankers reach destinations. But again, it's not, it's temporary. Fertilizer prices have not responded to the reclosure of the straits as yet. So bottom line is the reopening of the straits has appeared temporary, leading to a brief surge in oil supply, but we continue to draw down inventories to supply the world at a rate of about 6.6 million barrels a day, and inventories are finite. The longer this continues, the greater the risk of a sustained spike in the oil price. More on that later. So prognosis, more the same, basically. I don't expect these straits to be opening anytime soon. Stuart, your thoughts?
Well, it's a bit like one of those sort of sports events where you want both sides to lose, isn't it? Um,
Yeah,
well, I have heard the argument that this is actually part of a bigger plan of pressuring China via, reducing oil supply. It's just that the tactics don't really support the strategy. The when I don't like Trump, but in some ways he's got the wrong answers, but to the right questions. We don't want Iran to be an actor on the world stage. We do want to be pressuring them. It's just that probably Obama's deal was a better way of doing that.
yeah,
So Trump's solution is so feels just so sort of emotional and shooting from the hip, and they've landed in a quagmire that they can't get out of. And instead of China ending up on the worst side of this via lack of oil supply, they actually end up on the best side because the rest of the world sees America causing trouble and China sort of stepping aside and not being tainted by any of it. So the law of unintended consequences, isn't it?
Yeah, well, I agree with you on the China point. We talked about this previously on the podcast, how the US attacks on Venezuela basically removed another s supplier of Chinese oil and instead have actually diverted it to the US. And then, attacks on Iran and sanctions on Russia have basically a systematic attacks on Chinese sanctioned oil supplies, so cheap Chinese oil. But I think China is a big winner out of all this because essentially they have saved the world by cutting their oil consumption and releasing their black oil inventories, and they're seen as a sort of stable negotiating partner in world trade, whereas the US is just erratic, frankly. Okay, and on to economic news. Well, first of all, OPEC Plus has announced it will raise output by 180,000 barrels a day in August. Well, good luck with that. It's like their production is currently down by about 10 million barrels and they can't get any of it out. And that's mainly, Saudi and not the UAE because the UAE's left. Saudi and Iraq. So, they could, that is an increase in paper only. But when the war ends, expect everyone to be pumping like mad to try and get some lost revenues back. So elsewhere, the UK UK Q1 GDP growth was downgraded, I'm afraid, from 1.1% to 0.9% year on year. Not great. Business investment minus 1.3% year on year. Everywhere else in the world, we're seeing this huge surge of AI investment, apart from in the UK. Construction PMI was very poor, 38.4 in June, so the UK construction industry is still struggling. We had flash estimates for EU inflation in June, and that was really good, actually, minus zero point 0.1 month on month, thanks to falling oil prices, but also just a total lack of secondary effects. 2.8% year on year, core at 2.4%. May retail sales in the EU an anemic 1.6%. But good news, the unemployment rate was steady at an all-time low of 6.2%. So EU economy stagnation. In the US, well, good news. Q1 GDP growth was upgraded to 2.1% annualized from 1.6%. The JOLTS job openings rose to 7.6 million, which beat expectations. But non-farm payrolls came in at 57,000 versus 100,000 expected. Still positive. Um, but the May numbers were revised down. So May was purportedly a very strong 175,000. It's now been revised down to a still decent 129,000. Unemployment rate fell, also good news, to 4.2%, and the U6 to 7.9%. The ISM services and manufacturing PMIs both fell slightly but remained in expansion territory. The US economy seems to be doing okay. Market news, well, equities bounced back from their recent weaknesses over the past couple of weeks, despite renewed hostilities in the Gulf. All these figures are from before the UK market opened this morning. So, past couple of weeks, the FTSE All World's up 1.4%, S&P 500 up 2.9%, Nasdaq up 3.2%. The Hang Seng, which was having a torrid time, bounced back by 4.9%. Energy commodities were a bit mixed despite the closure of the Straits of Hormuz. So Brent past 2 weeks up 8.6%, WTI up 7, UK natural gas up 22%. That's not good for UK inflation. US natural gas, though, down 12% and coal down 10%. Industrial metals were generally a bit uppish, so copper up 2.2%, tin 8%, zinc up 4.8%, but iron was down 1.8% and lithium down 1.9%. The lithium bull market seems to be over. Precious metals had a bounce, but that bounce is fading once again as the oil price rises. So gold was up 1.5%, silver up 0.5, palladium up 4.5, decent bounce, and rhodium up 3.8. Some charts related to the news. Well, South Korean memory chip maker SK Hynix listed in the US. So this was a secondary listing. It listed US ADRs and raised 26.5 billion. Now we're seeing increasing number of IPOs in the US, which will have the effect of draining liquidity from the market. And onto equities, Stuart.
Right. Well, we've covered the summary. Just picking out a few salient things here. The Nasdaq up 3% since we last reported, and 13% over the year. And as Keith pointed out, a big bounce in the Hong Kong stock market, up about 5%. I think the other thing which attracts my eye is the VIX again. I mean,
Yeah.
at just 15, it's extraordinary given the the one of my views is that we're dancing on the side of a volcano in
Mm.
markets, and yet the VIX is very quiescent. It would seem to me that it's quite uh, a good time to buy insurance if you are into that sort of thing. Buying options at the moment is pretty cheap.
Yeah, I think that's probably a reflection of incredibly strong demand for options from retail. We've seen
Mm.
this big rise in one-day options. You know, Punters are speculating in options to, juice their returns. And we know punters are, small investors are generally very bad at this. So when the bull market's over, I expect VIX to rise again. But the other thing I'd point out is the Russell, which has been weaker than the S&P 500, and that's been reversing recent trends. And is that you'd expect the rising oil price to be bad for the great mass of US companies. And I think that reflects that. You'll also notice the all share did not join in the general rise in equity markets over the past couple of weeks.
So here is the All World Index, in a way, pretty flat actually for the past month or so. And here is the all share. So as Keith said, it hasn't really been joining any sort of global equity party. It's below the highs from the spring. Euro Stock 600 showing a bit more strength, however.
Yeah, given the continued weakness of the EU economy, the strength of the stock markets is surprising.
S&P 500 still looking fairly strong, really.
Yeah, is start of a new up phase? Question mark.
Hmm.
I think we're in a topping formation now. I think we talked about this last time, but semis are coming off,
But
and
we need to ask Simon, don't we, if it's got that?
well,
Yeah.
yeah, more on that in a bit.
Okay, right. Right. Nasdaq not so much in the party, possibly because of that weakness in semis. Russell 2000, yes, being weaker recently, but the longer term trend is looking more encouraging.
Yeah, still looks like it's in the uptrend, doesn't it?
Yeah. Hang Seng, yes, there's that bounce. The topics, well, I think we'll be covering a lot on Japan later, but a real asset in a inflationary economy. Bitcoin, well, God, it looks sick, doesn't it? The pound dollar, nothing really happening. Currencies just aren't the talk of the town at the moment, are they?
True.
Euro a bit weaker against the dollar, but again, within the scheme of things, these are fairly tight bands. It's not
Yes,
causing too many problems.
I totally agree.
Dollar index has bounced, however, overall. So presumably a lot of that was against the euro and, of course, against the yen. VIX, as we've been talking about, extraordinary. I tried to punt this occasionally. I know I
Mm,
shouldn't, but it never works because of the cost of carry is always
yeah,
against me when I use these spread betting platforms.
yeah. Just to explain that, um, short-term VIX, which we're looking at here, is low, but 1 month and 3 months forward, VIX is higher. So essentially, every time you roll, you are rolling. Um, against yourself, buying expensive VIX, and then its price falls as it gets towards daily VIX. And so, unless you have an immediate spike in volatility, you're going to systematically lose money.
Yes, that's what I did. I systematically lost money, Keith.
Yes. Well, I've also done that trade.
I mean,
And
very,
actually,
very small numbers, but just almost for fun because I could see this spiking not just to 30, but to 40 or something in some sort
yeah.
of correction. But I never get the timing right. Mm.
Yeah. If you're going to do that trade, it literally, you have to have a maximum of time horizon of a few days. I actually
Yeah.
did a My Worst Trade podcast on this. I'll include a link in the description.
Right. So picking out some highlights across the world for the first half, it's semiconductors, as in the measure here, which is I think it's the Philadelphia
Yeah.
Semiconductor Index, but also the KOSPI, the Korean index, where SK Hynix and Samsung have just gone to the moon.
Yeah.
Bitcoin, fortunately, at the other end. So just slight digression here, but I own some emerging market ETFs, and it makes an enormous difference which one you own. If you own
Yes.
the ones which are benchmarked against the FTSE Emerging Markets Index, you have not taken part in this because FTSE regards Korea and Taiwan as developed markets, which, as economies, they clearly are. Um, However, the MSCI regards them as emerging markets due to currency conversion issues. So if your emerging markets ETF is a MSCI benchmark one, then you've taken part in a lot of this. So you've
Mm,
had Taiwan Semi, you've had Samsung, SK Hynix, etc., and the performance difference is enormous this year.
yeah. Yeah. Thank you, Stuart. Interesting.
Right. So US TMT, well, this is like a momentum long short within the technology stocks. So we can see that through the back end of last year and the first half of this year, it was all about the momentum stocks within tech. And that has taken a big step change down over the past week, 10 days, but it's still a phenomenal picture.
Yeah. No, the numbers involved here are absolutely mind-blowing. But this looks like the peak to me. This, you have a blow off top, and then you go into an extended period of volatility, and we're talking about probably 6 months before the bear market starts. So that's where I think we are. What your thoughts, Stuart?
Well, it's very, very difficult to know, isn't it? Because if you look, for instance, at the forward PEs of some of these stocks, they're actually surprisingly low, even though the stocks are sort of up 5, 6, 7 times because of the cyclicality in the pricing and the volume of these sort of the suppliers into the AI boom. Um, it's all about how long will that boom continue? How long will demand for these things be? And what capex the companies will indulge in, given the pricing. I mean, I'm not taking part, except, of course, I am via my index
Yeah.
tracking holdings.
In the previous chart, we were talking about how the best performing sector had been semiconductors. And in particular, it's been memory chips. Now, as we've talked about before, memory chips, they're not cutting edge technology. It's a question of just capacity. And so the reason prices have gone through the moon, more on that later, because of huge demand from AI for data centers and no increase in capacity. Now, can new capacities coming online, and that, or I certainly think that AI data center boom is a cyclical thing and will fade. So at some stage, demand starts to fade and new supply increases, and um, memory chip prices go back to where they were. And it used to be a commodity and not very profitable, and it's going
Yeah.
now extraordinarily profitable. I think it goes back to where it was and probably worse because you've added a lot of new supply. So, yeah, It could go anywhere, but long term, it's going down in my books, and I don't think I wouldn't be buying it here. I think we're in the volatility before the bear market, personally. And yes, that the bubble is also in earnings.
So just to add one final thing to that, I think we've noticed over the past fortnight, both Meta and SpaceX have said that their compute capacity is now excess to what they individually need, and so they're selling that capacity in onto other AI providers. And that's completely the opposite of what they said that they were building the capacity for. They were supposed to be building it for themselves. So it
Mm.
would seem as if even in the tangible short term, that there is excess capacity in AI compute. Right,
Uh,
so more
oh,
more on Korea here. Um, so this is looking at the impact of domestic retail investors, and they have been dominating purchases on the Kospi. Also, it's got all the other signs of a speculative retail bubble. You're having double and triple leveraged ETFs on single name stocks. It's just absolutely extraordinary how we as human beings never learn. People are being
yeah.
suckered into this through the excitement of the story of AI and the reality of the earnings in these companies. But at some point, that the price has to bear some relationship to what the companies can produce long term. So
Yeah.
the Cosby has had various setbacks before and then resumed its upward trend, but it's deeply scary.
Yeah. Well, punters are notorious for getting their timing wrong. So they sell at the bottom and they buy at the top. And when we've got this huge bull market in the US, it seems that Korean punters wanted to join in. And obviously, the earnings of these big chip companies have been extraordinary, but that always ends badly. Punters are weak holders. At some stage, when prices are down and they're losing money, they will bail out again.
So this chart looks at the largest sector within the S&P 500. So, for instance, in the early 80s, it's the orange line representing energy. Later, it was IT in the dot-com bubble, and here we've got IT again. So it's the blue line again, and we've gone from representing about 17% of the S&P 500 to almost 40% in that sector. So
Yeah.
again, the concentration suggests that it's overdone. That the capital cycle will catch up with whatever sector is in the lead.
Yeah, but all I want to say about this chart is it is very, very strongly mean reverting.
Mm.
Yeah, those
Over
spikes
time,
over
yes.
time, those spikes they don't last. Yeah, you got like timing the when to get out is very important because it always comes down, and when it comes down, it goes right back.
Buying the dip, again, not a portfolio matters strategy, but this does appear to be the retail behavior at the moment. So we're looking at the average daily net notional um, net notional what buys when
Yeah,
the S&P 500 is up versus on when it's down, and we can see that the number for 2026 is quite extraordinary. Very high purchases when on a
mm.
down day, people buying the dip.
Yeah, and to be fair, it's absolutely worked in a bull market. It's great. But at some stage, the bull market turns where, and I think we're in a topping pattern and we'll be in a topping pattern for probably about 6 months.
Meanwhile, of course, the retail punters are making their own reality. The action of buying the dip causes the dip to be
Yeah,
compressed.
absolutely.
This chart is extraordinary, isn't it? 0 day options. I mean, an option to hedge yourself if you're a farmer, an option to protect yourself on interest rate exposure. All these things make sort of medium term economic sense. A 0 day option on a
Yeah.
financial contract is it's a bet, isn't it? You're just you know
Well, it's a way of trying to squeeze the share prices of some of the GameStop and the meme stocks to the moon. And if you can get enough punters to buy enough options, then you can force the market makers who have sold those options to go and buy a load of stock in the market. But I would be bet a huge amount that the punters systematically lose money on this, and the hedge funds, etc., are selling the options and making a packet.
I would be very interested to know if any viewer does have information on this. What's the sort of spread on a 0 day option? What percentage do you lose on the bid offer spread of these things?
Yeah,
No idea.
no idea either, but I'd be more. But also, what is the implied volatility? You know,
Mm,
how
yeah.
much do you have to, what return do you have to make on the stock just to break even? Question mark.
Flows into US equities have been remarkably strong this year. I mean, here we've got the average and the ranges, and 2026 is a big outlier. So,
Yeah.
but I mean, this is also back to the annoying point of look, for every buyer, there's a seller. Who are the buyers and who are the sellers for this inflow is flows into funds, but who's selling?
Do you remember the chart? The only chart that matters is
Yes.
the allocation of household wealth to equities. To, and essentially, when you're buying a US equity and there's IPO flow up until this point has been relatively modest, you're buying it from somebody else who, for whatever reason, has been selling it. And as the net inflow has been so strong, that means you must have been forcing prices up to encourage sellers because you're buying them off somebody else.
Yes, no, I see it. It's just that um, the flows must balance unless there's any increase in supply.
Yeah, but they're absolutely so, other people who have got out too early are the ones selling it to you, basically.
Yeah.
But at some
Um,
stage,
yeah. Well, we did cover very briefly, I think, last year, the inelastic markets hypothesis, which I think is quite interesting. But it's about this point of inducing a seller um, to sell when there's a buyer who is motivated to buy, i.e.,
mm,
regular monthly flows into index funds are a constant source of demand. So sellers have to be induced by a higher price, as you say, and they estimated this effect at 5 to 1. It was a huge
really,
ratio. So it's sort of gradual squeeze. And as
mm,
traditional, active, fundamental, value-based managers have been killed over the past 20 years, so everyone has had to, in a sense, join the party and become more short-term and more momentum-oriented.
yes, well, I think that's a good diagnosis, Stuart.
Right. Earnings forecasts for the S&P 500 are astronomically good. So forecasts are for a 20% rise in earnings in the S&P 500 over the next 12 months. And this is quite extraordinary given how high margins already are. You're in an economy growing at sort of 4 to 5% nominal with very high margins
Mm,
already. And yet
yeah.
earnings forecasts are predicted for an increase of 20% over the next year. It's quite extraordinary. Hedge funds are bailing out of TMT stocks. That's interesting.
It
Uh,
is, isn't it?
yeah,
Hmm. The smart money is getting
enough's
it.
enough. Yeah.
Hmm.
Oh, right. So back on margins. Well, here we go. The black line is the market X tech, the sort of range you might think, mid single digits. Uh, but tech itself, margins are astronomical, very volatile, as we've seen in the past. Margins have gone to zero on 3 previous occasions. I suppose the
Mm.
one point is that, of course, it isn't just the US economy's growth that's important. The tech stocks are obviously selling into a global market.
No, that's true. But when you think about the Kalecki-Levy model of US corporate, or sorry, just corporate profits, it is dividends plus investment plus government spending. And essentially, this is a symptom of the investment bubble, basically. Where if you think about, the hyperscalers buying, spending whatever they need on data centers and just bidding up the price of memory chips.
Yeah. Small cap margins like the market X tech look totally normal. It's the mega cap stocks, i.e.
Yeah.
the tech stocks that it's a different cut on the same story.
Well, actually, also think that this is indicative of the increasing concentration of the US market. So the US for many years has basically not been enforcing competition policy. So you're getting systematic mergers in all the industries, and instead of having 20 players, you've now got three, and they've got increased pricing power. That is very good for corporate margins, but very bad for workers.
Good point. Oh, right. Well, here we go. Here is that equation, isn't it? Isn't it?
Yeah.
So what of those factors? How do you pronounce it? Kaleki-Levy
Yes.
is going to lead to such a massive increase in earnings. Is it going to be investments? Is it going to be dividends? Reduction in household saving, even further reduction in government saving. It's difficult to see it persisting. That overall, that there's if you look bottom up, you look at the individual companies and you think, wow, this is so amazing. But you look
Yeah.
top down, how can the system overall support that level of earnings growth?
I just don't think it can. So when you go through these, dividends not changed much. Household savings, well, household savings are already quite low. They've been falling. So households can't dissave that much. Though obviously the government deficit is already enormous. And Trump will attempt to increase it a bit through the defense budget, which is trying to get up to 1.5 trillion from a trillion. But apart from that, he's not really increasing it. The government, the US trade deficit is pretty stable, not really increasing. So really, you're talking about investment. This is You're expecting continued and increasing investment to drive a 31% growth in S&P earnings over the coming, what, 2 quarters?
Is
Hum.
this partly also like an accounting effect that company A spends a fortune on memory chips, GPUs, whatever? So for company B, who is selling that kit, they report that as revenue and profit. Whereas for company A, they're only going to take a depreciation charge against that expenditure. So you get juiced earnings for the sellers of the kit and only delayed recognition for the buyers.
Yeah. Well, more on that in a second, Stuart.
Oh my goodness, this is extraordinary, isn't it? Um, so, in order for US corporate earnings to keep growing, then so would AI investment, and it is quite extraordinary. This is just
Yeah.
2025. This is
Yeah.
under 300 billion. This is not very much, Keith. We're jumping to 800 billion, a trillion. And
Yeah.
the extraordinary thing is that
Yeah.
the ratio when you compare to China, I mean, who knows where these numbers really come from? I mean, it's not just an order of magnitude. It's it's a double order of magnitude. US just under 300 billion. Then next up is China at 12. The UK bronze medal position, 6 billion expenditure
Yeah.
in 2025.
Yeah. Now, actually, the UK government, and we'll talk about this more later, has separately put out figures saying that UK investment in AI was 44 billion, which I don't believe because that's 1.4% of GDP.
Yeah,
So,
they're going to be including all sorts of things. You can easily imagine, how
yeah,
that would be totted up.
I think imagine that's pledges rather than actual investment.
Desynchronization of the global cycle has driven country correlations close to a multi-decade low. Interesting that this is
Yes.
cross-country equity performance, is it?
Yeah. Isn't that
Uh,
interesting?
right. So that means that we can get a diversification benefit from global exposure. We also get underperformance from a global equity
Oh,
exposure rather than a US
yes,
one.
exactly.
Yeah.
Yeah. Thank you, Stuart. Well, we're talking earlier about semis. Now, and Stuart was talking about GPUs and capacity. Well, I saw this chart on Zero Hedge, which suggests that the rental price for the H100 GPU had fallen quite sharply in June, which would suggest that we already have overcapacity in data centers. And that is quite a big fall. It's going from 3.2 to 2.3. So you're talking about a fall of a third roughly. So I looked for corroboration, and yes, they are down. These are H100 chips, recovered a bit, but you know, prices do appear to have peaked. Newer H200 chips have also fallen, although you'd say that the spike seems to have been a temporary one-off, but certainly not rising. You break it down into the different generations, and H100s are described as modern, and that is the grey line, rather than the latest. Actually, what appears to be happening is not a decline overall in prices for GPUs. It's more that people just want the new ones. So you're getting increased supply of the latest generation, and people are bidding up for um, the latest generation. So the prices are still rising, but the prices of the older generations are falling. So switching rather than a general fall in GPU prices. But token expenditure does appear to have peaked. And if people are spending less on tokens, doesn't that mean that the AI companies are getting less revenue and that their spending on data centers should also start to moderate? Question mark. Meanwhile, reminder, hyperscalers are investing all their free cash flow in AI and data centers. And onto memory prices. Now, last week, we were talking about this chart. This is the capital expenditure of the big memory chip companies. And I was saying that this is the capital cycle in action. So what you're seeing is big surge in cyclical demand for memory chips. The memory chip manufacturers investing in excess in new capacity, so new supply. At some stage, the cycle will turn, demand will go down, and supply will massively increase because they're all investing in it, and you'll see a huge collapse. Now, SimonW pointed out that yeah, that's true, but the cycle plays out in years, not months. How long does it take to build a new plant? Actually, 3 to 5 years for a memory chip fab. Adding an extra production line in existing facilities takes 1 year plus. So, investing now will mean new capacity in the coming years, not in the coming months. So, um, this is trouble for the future, not for, the next few months, etc. Simon expects X surplus to supply to arise starting in around 2028. And I don't think that's a bad estimate, frankly. So, what we're saying is the capital cycle has started, but it's going to be, in my mind, the prices will downturn on demand shortfalls as the cycle turns rather than increasing supply. When increasing supply comes online, it's going to be deadly. So last week, and this is indication that the cycle may be turning already, Samsung shares fell after announced record Q2 earnings, despite, and these are quarterly profits, of 58.4 billion, 19 times what it earned in the same quarter in 2025. So already investors are starting to worry about the sustainability of these earnings as new supply starts to, they can see new capacity in the future. And this is the price of DRAM prices. And you can see how much they've risen over the past couple of years. I mean, look at DDR4, 64 gigabytes. You know, they've gone from what's that? Say 100 to well over 1,000. So that's 1,100, up 11-fold in the last couple of years. Extraordinary. And typically, analysts are expecting them to keep on rising on the back of AI investment. Is all I can say. Because in the long term, this is the trend in DRAM and NAND prices. Yeah. Steady falls, basically, apart from in the past couple of years. This is
And that's on a log chart, isn't it?
It is. It's a log chart, medium term. So that was in real terms. This is in nominal terms, still the same, although, obviously had a bit of inflation. Um, but medium term, that trend will reassert itself. You heard it here first. Bottom line, current high memory costs are prices are an anomaly. They'll last months, not years. Expect memory prices to fall back to trend in the future, or frankly, I think they'll go below trend as demand falls and supply increases. Stuart, any thoughts?
No, I think you've covered it. It's a classic capital cycle, isn't it?
And quickly onto Bubble Watch. So I thought this was really interesting. This was Panmure Gordon, as quoted by the FT, and I'm going to read this out. In 1929, the cyclically adjusted PE ratio, the CAPE, of the S&P 500 reached 32.6 times, according to Professor Schiller's data. That was 1.8 standard deviations above trend. In 2000, CAPE reached 44.2 times, or 3.3 standard deviations above trend, and that was a clear sign of the bubble. However, as the chart I'm about to show you shows, earnings in both instances were within normal range, less than one standard deviation above trend. Today, CAPE is at 41 times, or 2.9 standard deviations above trend. Again, we are clearly in bubble territory. However, unlike in previous bubbles, we also have extremely high CAPE at a time when earnings themselves are 1.8 standard deviations above trend. In other words, we're in a valuation bubble at a time when earnings are also in a bubble. If we correct for the earnings bubble, the current CAPE would be 67.6 times, or 4.6 standard deviations above trend, a bubble that surpasses anything ever seen in US history by an extreme margin. If valuations followed a normal distribution, which they don't, this would happen 0.00019 times percent of months, or once every 43,000 years. So there you go. We're in a double bubble, an earnings bubble and a valuation bubble. And when we talk about tech earnings, which are rapidly rising, which are based on, huge expectations for AI demand, well, the grey bars are sectors which expect to use AI heavily, and they ain't growing anywhere near as much as US tech sector earnings. Are earnings getting a bit ahead of themselves, we wonder, on AI investment? So I'm going to go through this quite quickly. How does this bubble burst? What are the signs? Well, reminder of the mechanics of the great financial crisis. So it was driven by subprime borrowers taking out mortgages on low teaser rates, knowing that they couldn't afford the full rate when the teaser rate ended, typically after like 2 years. And what they were hoping for was that continued rises in US house prices would allow them to renegotiate their mortgage, have with more equity, and get onto a new teaser rate when when they had to refinance. Now that model worked as long as house prices continued to rise strongly. But the delinquency rate started to rise not when house prices fell, but when the rate of house price rises started to ameliorate, i.e., the housing market started to decelerate. And you can see that here. So the blue line is house price appreciation year on year, and the red line is the delinquency rate. And you can see the delinquency rate started to rise as the pace of house price growth started to fall, i.e., the housing market was decelerating. Now, house prices turned negative in 2007, but 2 years previously, delinquencies had started to rise. So deceleration was the signal that the housing market was peaking, and it then took a couple of years before the crisis arrived. But the signal was there at deceleration. So look for deceleration in a trend as a start of the end, is essentially what we're saying. And the AI capex boom is really a credit-driven real estate boom. What you're doing is you're building a structure based on, funded through actually debt in a lot of cases, in the case of Oracle, or through earnings plus debt in the case of, let's say, Microsoft. You then build the structure and lease it to tenants on a take or pay basis. So the way this works is AI commits to buy tens of billions of dollars of compute from Oracle, CoreWeave, or hyperscaler. The counterparty then books that as future revenue and borrows against it to build the data center. That works only as long as OpenAI can meet its commitments. And OpenAI, is currently loss-making. So this is not really a software business. It's a real estate business that owns compute. So real estate cycles start to break when the rate of demand growth decelerates, just as new supply comes online. And reminder, these are the commitments of the OpenAI companies. They've got absolutely enormous commitments, 18.8 gigawatts in the case of OpenAI. And OpenAI is unprofitable. And therefore, how's it going to fund all these commitments? It needs to continue to raise capital either through share issuance or through bonds, and its ability to do so is also a function of the appreciation in its share price, which is decelerating. Total AI developments of 1 trillion are secured against contract commitments from OpenAI and Anthropic. And these are the various companies, Microsoft, Oracle, Google, and Amazon's commitments from OpenAI and Anthropic. So OpenAI, its current revenues are about in 30 billion in 2026. By 2030, it's forecasting a 7-fold rise in 4 years. And even if they achieve that, and we really question whether they're going to achieve that, they're forecast to burn 115 billion. Everything has to go right in order for hyperscalers to get their money and this not to turn into a classic real estate bust.
So, Keith, any surprise that OpenAI is now snuggling up to the US government and is offering to sell a stake in itself? For the communal good, obviously.
Yeah, no, it's a good bit. Basically, It's if you bung Trump some money, you generally get, a multiple back. So it seems like quite a good gambit by OpenAI. So that I mean that's it really.
So one further piece of data that I saw this week on the fantasy finances of the AI companies, you'll be pleased to know, Keith, that revenues have now exceeded depreciation charges.
Great. Everyone's making money, not right. So the basically this is it. The AI capex is decelerating. Everything's decelerating. The share price appreciation decelerating, or may frankly have peaked. AI capex expenditure decelerating. You've seen the GPU rentals yields decelerating. So does that herald not necessarily the immediate end of the AI bubble, but the start of the beginning of the end? The way this bubble will burst is when the market begins to fear that OpenAI won't be able to meet its compute commitments. At that point, it goes pop because the data center companies, CoreWeave, etc., have all raised money based on those commitments. And then there will be queries about the future solvency and the ability to pay, credit stress, etc. Stuart, your thoughts?
Nothing really to add. I think you've covered it very well. It's got all the hallmarks of a huge cycle. Suppose one observation is that I think Google has played this very cleverly. It's got the cash flow. It looks to me like it's going to be one of the last men standing because it's got the engineering quality, the cash flow to support itself. OpenAI seems the completely other end of the spectrum, so flaky, so unlikely to persist. And Anthropic is hoping to, and is maybe the best of the non-quoted AI companies in terms of financial prudence. But even that, it still looks sort of so scary when you could quite easily copy a Chinese model, use that at 10% of the price that the frontier models want to charge. So
Precisely.
yeah.
And I'm not sure whether to believe this chart, frankly, but it says data center construction has already started to fall and fallen actually in not just decelerate, but actually has been falling. Now, that seems to contradict a lot of the other charts we've seen. But to be fair, the other charts were commitments. This is actual expenditure.
It does seem odd when you look at the data center construction in US dollar billions, only 10 billion? That doesn't seem
Yeah.
likely.
Yeah. That is growth, though. That is growth rather than actual. But still, you're right. And the bond market is becoming increasingly skeptical about the AI euphoria. So this is the bonds, the long-dated bonds of the hyperscalers, etc. And essentially the spread between their 2031 and 2056 bonds. They are charging more to lend longer term. So they're worried about the long-term profitability of these hyperscalers and therefore about the long-term sustainability of earnings. And that is quite a premium actually for Oracle, over 5%. They are saying actually there's a decent risk Oracle will go bust. And on to commodities, and first of all, energy commodities. And renewed war has been good for Brent, which rose 8%, over 8% to 79.4 this week. Still a long way down from its highs at the start of the war. WTI up 7%. Sadly, UK and Dutch natural gas futures up strongly, up 23.5% for EU, up 22% for the UK. Lots of LNG trapped in the Gulf. Qatari natural gas fuels are not Qatari natural gas flows are not going to normalize anytime soon. In the meantime, milder weather in the US has caused US natural gas prices to fall. There's also the Freeport LNG terminal is offline for a bit, so you've had reduced demand from LNG. Coal having a bad run, down 10% over the past couple of weeks. Uranium flat. So this is Brent heading back up again, but still a long way from its recent highs. WTI the same. Now we've had the latest global oil inventory numbers for June from the EIA, and for oil bulls, this ain't great because they have revised the historic series up. So they've now estimate that there was more oil in the system than they thought last month. Now, previously, as we've discussed, they kept on revising it down, but they now think actually there were 2.83 billion barrels of oil in inventory at the start of the year, up from 2.82, and they've revised up their estimates for previous months. So when you look at current estimates of oil inventories of 2.603 billion, that's actually up compared to their estimate for May. So oil inventories net up, although they're saying that overall they think there was a 48 million barrel drop over the course of June. They've revised the whole series up. In the US, inventories are down 26 million barrels over the course of the last couple of weeks. Excluding the SPR, they're down 5 million. So there's a big SPR release. SPR can't be drawn down forever, but US crude production continuing to rise and now up on the year. The Baker Hughes rig count is also rising and is up 33 since the start of the year. And that's actually, a decent rise. That is up, 7% since the start of the year. So you are seeing US drillers going to work. Now, the IEA estimates that because of all those fully laden tankers surging out of the Straits, oil inventories actually rose last month because you had this rise in the oil on water back to pretty much record highs. Although obviously oil on land continued to fall, but net up slightly. And the EIA is forecasting that production will surge next year to new all-time highs, driven by a big rebound in OPEC production. So basically, OPEC are going to start pumping at full capacity. But also, and this is not what we wanted to see, they think US shale will continue to grow. Now, we have been expecting US shale production to start peaking, and because you're about 50% of the way through the drilling sites. But obviously, it's also a question of price. You can just accelerate your drilling, and for a bit, you'll get more oil out, but you're still running out of drilling sites. Eric Nuttall has been saying for a while now that the US can't draw down the SPR, Strategic Petroleum Reserve, much below 300 million barrels, which is its minimal operating level. Well, we're getting very close to that. And so he's saying we're going to see the SPR, not being able to draw down anymore, which will lead to a spike in oil prices, etc., etc. But oil markets seem incredibly sanguine. Frankly, if this was true, then you'd expect to see oil prices rising much more than they are. So I am skeptical. Meanwhile, Ukraine has been taking out the Russian shadow fleet, and that is also bad for global oil supplies. This EU natural gas prices actually risen a lot more than oil. UK, same. US, going nowhere. But all those data centers generally takes them 4 to 7 years to be connected to the grid. So a lot of them will be using their own generators driven by natural gas. And that is Doomberg's bullish natural gas forecast explanation. And this is coal down, but still well up from the start of the war. Uranium going nowhere. Industrial metals, Stuart.
Right, well, fairly quiet, I think, in the past couple of weeks, isn't it? A small rise for copper and a much bigger rise for tin. But in the scheme of things, to me, that seems like a fairly uneventful couple of weeks.
Yeah,
Here's aluminium. Goodness, extraordinary. Yeah, a fall from 3,800 to 3,100, seemingly stabilizing, if that's if I've got any ability to read a chart. But I think
yeah.
the bigger story is not too much happening. But no, I thought that this might rise a lot with the with the resumption of hostilities.
I'm exactly the same. I thought you know, the inability to get aluminium out of the huge smelters in the UAE and Qatar, you'd think would cause the price to go up, but no.
Well, that's a weird chart, isn't it, for cobalt? Lack of data, I think, like all year it's been stuck at exactly the same number.
Actually, it's the DRC, Stuart.
Okay,
They have put export quotas on and they're managing it,
right. Hmm.
but they've got huge stockpiles. You know,
Hmm.
hum.
Copper. That's quite interesting. We know the long-term bull case, and it hasn't really taken too much of a step down, has it?
No,
It's seemingly wanting to go higher.
but that has risen a hell of a lot in the past year.
Hmm. Yeah. Iron ore, my goodness, that's a massive step change down, isn't it? Uh,
Yeah,
so you got a note here. China has paused purchasing agreements with BHP and Fortescue Metals as it asserts its control over the iron ore market. China's smelters have excess capacity. So, right, they're not buying anything.
yeah,
Lithium, yeah, well, it back end of last year rose a lot and has been sort of broadly flat since then, hasn't it? Neodymium, a bit more of a rise just recently. What's the main use of neodymium?
neodymium is used in magnets. So
Uh-huh.
the super strong magnets you get in pretty much everything these days use neodymium, and in particular the yeah generators in wind farms.
Right.
So you have literally tons of this stuff. Those magnets weigh tons, and you need like hundreds of kilos of neodymium.
And
So
this is the classic sort of rare earth squeeze from China type fear, is it? That's what drives
yeah,
this one. Yeah.
yeah. And
Mhm.
notice this is the price in China.
Nickel's come off quite a lot in the past month. Tin, however, bouncing up a bit. Is there much story
Yeah.
here, or it's just normal volatility?
Well, tin is rare in the Earth's crust and essential to electronics. So
Mm.
we've got this huge surge in semiconductor demand. Relentless bid under tin, essentially.
Zinc, oh, similar up, bottom left to top right story, isn't it?
It is. Yeah, that's surprising. On to precious metals. Do you want to carry on?
So some small rises in the past fortnight for gold, up 1.5%, platinum also 1.5%, rhodium and palladium too. But the biggest story this year, of course, is the fall from the exuberance of the back end of last year and beginning of this year. So the debasement trade has sort of faded from market narratives. When the performance of gold just doesn't seem to relate to the traditional stories about risk on, risk off. Its correlation seems
Mm.
to evolve, every few years. So
Yes.
yeah, it has not been a safe haven during the Iran conflict. Well, yeah, here is gold. You might be interested to know, Keith, that towards the beginning of June, when I thought, oh goodness, the exuberance has come off, we've retreated from almost 5,500 to 4.5. I bought a little bit extra of gold just before
Mm.
that drop, stepping off the cliff from 4.5 to 4,000.
Yeah. Well, I mean, I bought some up here and then got out, somewhere down here. So, it's difficult to know, isn't it? I thought it was debasement trade, and it turns out it hasn't been.
Yeah.
So,
I mean, Richard, of course, would say it's all about time perspective and the
yeah,
strategic merits remain.
yeah,
Gold got a margin call in China. Now, I wasn't quite sure what these statistics were. I mean, how can you have a 100% margin on something? That just means you're buying it. You're not buying it on margin. Is that correct?
yeah. Actually, that is a very good point.
So, but the point is that margin requirements have been increased, but it still seems strange to me. How can you have a 120% margin requirement or 140% from these Chinese banks? Isn't that the same as you've got to overpay for what you're
Yeah.
buying?
No, that is a very good point. So if you hold it basically financially, it's it's going to cost you more than just going and buying it. You're
Hmm.
right. They hadn't concentrated on the absolute numbers previously, but yeah, that seems very odd.
Central banks are still buying, however. I'm always nervous about how on earth one can get the data on this sort of thing, but
Mm,
the data seems to come from IMF, respective central banks, and the World Gold Council, which is saying that the purchases have outweighed sales, which has pretty much been true for the past 2 years, except in March this year when sales appear to
yeah.
be more.
I would say there's no correlation with the gold prices there.
Just steady buying, which would argue in favour of Richard's view that look, this is a strategic
Yeah,
position which central banks are supporting. So some money has likely flowed from gold and Bitcoin to semiconductors. Oh, right, this is looking at ETF flows, is it? So that this is
yeah,
people chasing the latest story and creating
yeah,
momentum. Yeah. The gold bear case in one chart, basically that it's over it. That move up to 5,500 was just too extreme, and presumably this is some sort of regression on real yields, the level of the dollar, the level of equity markets, and copper. So you've got a model which seemed to have a reasonable track record, and the price of gold just went way beyond that
yeah,
justified by that regression model.
exactly. And now it seems to be heading back towards the regression line. And, they would say that there's a strong mean reversion in this chart, and it's likely at some stage to get back to that
Mm,
over the course of years, though.
yeah. Silver, my goodness, that's taken a real beating, hasn't it? There was that extraordinary squeeze up
Yeah.
until in January and uh, almost to 115 dollars a troy ounce, and that's pretty much halved, hasn't it?
Yeah.
Yeah.
Was it Goldman Sachs was saying that they expected it to get to 320 this year? Well, it
Well,
ain't happening.
perhaps we should have a section where we look at forecasts that were made, 18 months,
Yes.
2 years ago. Look at outcomes.
Yeah, no, you're right. Actually, I should start doing that.
Platinum, superficially, that looks like a very similar story to silver, doesn't it?
Mm.
Rhodium, rather different story. Some sort of spike early this year, which has reversed.
Yeah, but it all looks like speculative bubble basically that's now unwinding.
Yes, which is why that regression chart was quite interesting. It does give some
Mm.
sense of what was exuberance and what was fundamentals.
Yeah.
Palladium, yeah, sort of similar story.
Great, thanks, Stuart. On to rates. Now, Um, obviously, the rise in oil prices over the past few days has not been good for inflation expectations and therefore for bond yields, which have been rising again, sadly, up across the curve. And you'll notice at the short end, the UK yield curve is now at what, 4.3% for the 2 year. So it's pricing in two rate rises. I can't see it happening, frankly. In the US, again, you're pricing in best part of two rate rises in the next 2 years. So market is saying no more rate cuts, rate rises due to higher oil prices and higher inflation expectations. And I thought this was interesting. Has the Fed already cut too much if you look at the Taylor rule, it's saying interest rates in the States should be at least 1 full percentage point higher than where they are now. So is US monetary policy already too accommodative? Okay, so this is the UK 2 year, bounced back a bit, but still well down from its highs as oil prices have not gone back up to their highs. But what these charts mean is essentially if we get a renewed, an extended conflict in the Middle East leading to much higher oil prices, then I'm afraid bond yields are going to keep on rising. This is the 10 year, this is the 30 year. US 10 year, that's back to highs towards its all-time, well, recent highs. Germany, the same. France, the same, hasn't really come down. Italy. Japan, now, Japanese bond yields have fallen over the last few days, and we'll get onto this because they have mandated pension funds to buy more domestic assets, including bonds. So hopefully improving demand for Japanese bonds. Now,
Keith, sorry, just before we move on to the next section,
yeah,
while we're talking rates, just a brief aside, but US tips that they interest me. I think I've mentioned this one before, but long dated US tips, are yielding sort of 2.25, 2.5%.
yeah,
And to sort of the actuary in me, that this seems like really pretty attractive if you can get something approaching real GDP growth on a supposedly risk-free asset. That strikes me as a very good bolt hole at a time where equity markets are so elevated. So,
yeah.
I mean, I haven't made a big switch, but the only latest purchase I've made is of US tips.
Actually, while we talk about what we've done, I have started, I've been selling my UK financials, the banks, just cutting basically equity exposure and increasing my cash holdings. So,
Oh, cash. Yeah.
so I've actually gone into the UK 5 year as a just a cash proxy because this could take a couple of years to play out, but actually I'm trying to reduce equity exposure, frankly. Quickly, current investment themes. And the only thing I wanted to talk about here is previously we talked about disruption from the war in Iran. Last week we're saying that markets were confident that it could be managed, and they were right. Well, haha, I was right. We're back on to war rather than jaw. So, hurrah. Um, and actually, I'm going to add to this Japan. We can talk about Japan now, but the yen has been trending systematically downwards, bond yields systematically upwards. Are we heading for a fiscal and a debt crisis in Japan? So the big section this week is on Japan. Now, Stuart knows a lot about Japan. So I thought as he's here, we would do this, which I prepared actually a long time ago, but because of the war in Iran, we haven't really had a chance to do it. But you'll know that the yen has been selling off and Japanese bond yields have been rising relentlessly. So the question is Japan heading for a debt crisis? So first of all, let's look at what's happening to the Japanese economy. So let's look at the fundamentals. So the population has been falling now for 9 years, and the rate at which it's been shrinking has been accelerating. It's now falling at 0.5% per annum. And that is being driven by very low fertility rates. And this has actually been going on for much longer than I thought. So actually, the Japanese replacement rate fell below 2 back in the 1970s and is currently at 1.2. and that was in 2023 data. But apparently, in the last couple of years, it's had a bit of a bounce back to 1.4, but still well below replacement rate. And that means the working age population will drop by around 50% in the next 2 generations. And you can see the effect on the Japanese population in this chart from Our World in Data. So essentially, the working age population peaked in 1994 at 87.5 million. And that's the green area. It has since fallen to 73.1 million. And that's a fall of 16.5% in 20 years, so 30 years. Meanwhile, the number of children has been falling, while the number of older people, and that's 65 plus, has been rising rapidly. That means that a falling working age population must support a rising elderly population. And that's a particular problem in Japan because the elderly are the longest lived in the world, just about. So the UK has life expectancy of 81.3, and Japan, people live for an extra 3.5 years. So in terms of retirement, when you retired in the UK, you live for an average, 16 years? In Japan, you live to almost 20. So you live 20% longer, pension liabilities are 20% longer. That is actually quite substantial. So already, Japan has the highest old age dependency ratio in the world, with 50 people aged 64 plus per 100 workers, and that will continue to rise. Meanwhile, and this is an extraordinary chart, Japanese productivity is even worse than UK productivity. A, in absolute terms, but B, it has gone precisely nowhere in 15 years? Whereas at least the UK's is up a bit. So when you think about the fundamentals of the Japanese economy, you have a declining workforce and you have stagnant productivity. So, and therefore, in order to get rising GDP growth, you need a lot of capital deepening. So you need a lot of investment because the other components of GDP growth are both either shrinking in the case of working hours or stagnating in terms of total factor productivity. So that means that GDP growth over the past 10 years has averaged 0.5% per annum, i.e., even worse than us. And that's going to make servicing government debt of 250% of GDP a problem. Now, you'll notice that actually Japan's debt as a percentage of GDP, and this is gross government debt, has been declining. And that's because the post-COVID inflationary surge has been very good for the Japanese debt burden. So that's resulted in higher nominal GDP growth, and the existing bonds had very low coupons. So their real value has eroded. But already Japan spends 25% of its budget on interest costs, and that's expected to rise to 30% by 2030, i.e., only 4 years away. And that is despite the average interest on outstanding JGBs only being 1.2 to 1.3%. Now, as you take you through the charts, you'll see that the yield on the 30-year is 4%. The yield on the 10-year is 2.8%. So rising bond yields will tend to force the debt service costs upwards, and making the debt burden increasingly unsustainable. So your danger is a debt spiral where, in order to fund higher interest costs on the outstanding debt, you have to either issue yet more bonds or you have to raise taxes. And actually, you're at the point where raising taxes, 25% of the budget is going on interest costs, is impossible. It's too much already. So, summary, Japanese economy is aging and highly indebted, and the workforce will continue to shrink. That is a given because that's a function of birth rates over the past 20 years. It also has surprisingly weak productivity growth. That means weak GDP growth. And it's got gross debts to GDP of about 250%. And debt service costs are expected to eat up 30% of the budget by 2030.
Keith, just to add one perspective here, Japan is interesting for being Japan, but it's also interesting as a possible harbinger of what China will go through, given the similar demographic profile, the similar property boom and bust. And obviously, if China went through something similar to what might happen to Japan, the implications for the globe are much bigger.
Actually, it's very interesting you say that, Stuart. We're not going to have time to do it this week, but I've got a section prepared on um, a debt deflationary trap in China and the bursting of its property bubble, which property prices in China have fallen sharply, and the size of the property investment bubble in China was actually bigger than that of Japan. So is China, like Japan, going to go into a balance sheet recession? Coming up in next time's podcast. But this time, moving on to inflation. Now we've seen rising bond yields in Japan. Is that a function of inflation? Well, you'll see that inflation in Japan surged post-COVID, but actually, despite the rise in oil prices in recent months, Japanese inflation has actually been falling below the 2% target and is currently at 1.5%. Now, I listened to a podcast by the chief economist at SBI Securities, and he was skeptical that the country can sustain at 2% inflation in the medium term because of declining demographics and a structurally weak economy. And so he believes the Bank of Japan will struggle to raise interest rates much further. So this is headline inflation. When we look at core, it's down to 1.4%, and the trend appears to be down.
I think
So
that there's a big discussion, isn't there, between good inflation, which is demand driven, and bad inflation, which is imported energy and food inflation. And so far, most of the inflation for the past couple of years seems to have been of the bad variety.
yeah, so he was saying that you did have some demand-led inflation, but it's feeding again. And,
Mm.
you know, it's not clear that Japan can sustain 2% inflation. But counter to that, wage growth has been much stronger. This year it's 3.2%. And given low productivity, that should be inflationary. And this is Japanese interest rates. So they were stuck at 0% for a decade. And worse than that, they had, first of all, a zero interest rate policy and then a negative interest rate policy where they're actually charging banks. Um, they were taxing banks according to the size of their balance sheets, trying to get them to lend money out. Well, that's all over. And now we're up to 1%, and markets are expecting another rate rise in December. But we question whether weakening inflation and a stagnant economy will allow the Bank of Japan to raise interest rates much further. So, in summary, the post-inflationary surge appears to be weakening, with inflation back down to 1.5% or core 1.4%. And that means the Bank of Japan is not going to be able to normalize interest rates with the rest of the world. So, Japanese interest rates 1% rising to, let's say, 1.25 or 1.5, whereas US interest rates are currently 3.5 to 3.75, and the market is pricing in two further rises. UK interest rates are 3.75, and again, markets pricing in two further rate rises. So there's a yield gap which is likely to remain for the foreseeable future. And so what is happening in the markets? Well, the yen has been selling off relentlessly. And the Bank of Japan has been intervening. In May, it reportedly spent 74 billion supporting the yen, stopping it falling further, or nominally rising against, so the rate rising on this chart against the US dollar. Now, important point is the yen is extraordinarily cheap in purchasing power parity terms. The SBI Securities chief economist was saying it is 4 standard deviations cheap. So its purchasing power parity would be about 93, and it's around 162 currently. So it is really cheap. Hence, it's a great place to go on holiday. But you'll notice that it's been getting cheaper, and its cheapness has not been a support. So there have still been net capital outflows from Japan, despite the fact it's a very cheap place to live on a purchasing power parity basis. Oh, sorry, it's a very cheap place to visit on a purchasing power parity basis for foreigners. So its real effective exchange rate is essentially halved over the past 25 years. Meanwhile, the yield on the Japanese 10-year has been rising relentlessly, although it did fall 10 basis points on Friday on news the government would encourage domestic pension funds to increase their holdings of Japanese financial assets. That is financial repression in action. The 30-year is at 4% best part of. So, and that has been rising relentlessly. This has imposed massive losses on anyone who holds long-term Japanese bonds, i.e. the
Talking of which,
banks.
Keith, and talking of financial repression, you mentioned the government sort of jawboning company, pension funds, insurance companies to buy Japan. But one other way that they've been doing it is requiring a much better match between assets and liabilities at pension funds and insurance companies. So previously, those companies hid out in the short end of the yield curve and in foreign assets, but they're being forced, not just jawbone, but forced to better match liabilities and forced to buy some of this long dated debt.
Yeah. Well, we were there way before them,
Mm.
mandating asset matching for UK defined benefit pension funds. And it worked until it didn't. Defined benefits have fallen out of fashion, because actually, if you invest in equities, you would have done much better. So pension funds that invest in equities did much better. So what the market dynamics are showing is that when you stand back and look at this, it would appear that Japan is in an EM style debt crisis where rising bond yields are not supporting the currency. So is the market actually saying that we're already in a debt crisis in Japan? Question mark. And reminder, emerging market debt crises end through a combination of fiscal consolidation, i.e., being forced to cut the budget and fiscal discipline, and debt restructuring. And you get there through a crisis. So let's talk about the yen. Why is the yen selling off? It's because of the carry trade. We showed you earlier that interest rates in Japan are currently 1%, whereas in the US they're 3.5 to 3.75%, i.e., you can invest at 3.5% and you can borrow at 3.75%. So if you borrow at 1% in Japan, you can then use that money to invest in US Treasuries at 3.5% and get a big uplift in yield and return. And while the yen depreciates, you're also getting an additional return on the currency. But also, is there fear of fiscal sustainability? So the sell-off in the yen has accelerated since Sanai Takaichi has become the favourite to win the premiership and then became prime minister. And she was running on a platform of explicit further fiscal stimulus and tax cuts, and has since unveiled an investment package worth 2.3 trillion over the next 14 years. So the massive Japanese debt burden is set to increase further, and the fiscal deficit is expected to increase as well. So notice the yen has accelerated its sell-off since she became favourite, and JGB yields have accelerated as well. So it would seem from market action that the markets are responding to Takeichi's premiership and the threat of further fiscal stimulus. And this is her spending plans. The next 14 years, 2.3 trillion. And it's going on, AI, robots, chips, technology, hoping to get higher productivity. Japan needs higher productivity to rescue its economy. Now, the Bank of Japan has FX reserves of 1.3 trillion. Surely it can use that to support the yen. Yeah. So this is the history of Japanese interventions. And so this is an inverse chart. The y-axis is inverted. So falling is weaker yen. Yeah. And so these are all the times it has intervened in the market. So the Bank of Japan does use some of its FX reserves to support the yen. The trouble is, if it were to systematically intervene in the market, it would face problems because much of that 1.3 trillion is held in US Treasuries. So Bank of Japan sells US Treasuries and buys the yen to support the currency. But its selling of US Treasuries would then cause, all else being equal, yields on US Treasuries to rise, which would increase the spread between US Treasuries and Japanese bonds, which would make the carry trade more profitable. Speculators would therefore increase their positions in the carry trade, selling yen and using it to buy US dollars, which would cause the yen to depreciate. And you get into this vicious circle, potentially. So the Bank of Japan is going to find it difficult to sell all those treasuries to stop the decline of the yen, because it could be self-defeating as long as there are enough speculators willing to invest in the carry trade and borrow cheap yen. As long as the as long as Japanese interest rates are much lower than interest rates in the rest of the world, then you'll see a steady flow out of the yen to support an ever increasing carry trade. But The danger is the carry trade is already huge and crowded, and any risk-off environment which cause an unwinding of those positions would cause short, sharp appreciations of the yen, which is incredibly cheap on a PPP basis. Stuart, any thoughts?
In some ways, you have a better perspective than I do because, in a sense, I'm sort of closer to the day-to-day news flow, and this is picking up a bigger picture. I've always assumed that the yen weakness was more a function of money printing than of the carry trade, but you're emphasizing carry trade. So in my mind, Japan, huge debts, low growth. You wouldn't want to lend to Japan. So interest rates would normally be expected to be higher, or at least, sorry, bond
Mm.
yields would be expected to be higher. But to support the economy, the BOJ was buying, well, was monetizing the debt in effect. So the pressure in the system was coming out not via higher bond yields, but via a lower currency. So to me, it was, uh, you remember like 15, 20 years ago, there was always this talk about the widowmaker trade where
Yeah.
people were people were shorting Japanese government bonds because they could see the debt levels and low growth and demographics. But it never worked
Yeah.
because QE was so extensive, the money printing was so voluminous that it was really the currency that took the hit, which in a way socialized the losses that Japan had suffered
Mm.
across the whole population and the whole population's wealth and purchasing power. But you're emphasizing more, the carry trade aspect.
Well, it's a question of what's forcing the yen down is flow. And I take it about your point of money printing, but the symptoms of money printing are higher inflation and an erosion in the real value of the currency as reflected in PPP. And you'll see that actually we're a hell of a long way from purchasing power parity. And what's causing that is a steady flow out of the yen.
Mm.
Now, the other problem the Bank of Japan faces is that according to IMF rules, to remain classified as a floating currency, a country cannot execute more than three currency interventions in a rolling 6 month period. And each episode can only last for 3 days. Now, if the yen were no longer to be classified as a floating currency by the IMF, I'm not sure that they would be too concerned about that, frankly, but this is a constraint, nominally at least. So, why are Japanese bonds selling off? Well, fiscal policy is loose and loosening. We've seen the 2.3 trillion of new stimulus in the next 14 years, and that is there's no pressure on her currently from the populace to row back on that. So the fiscal deficit will continue to grow. And if anything, the government is also committed to invest in defence, which wasn't part of that 2.3 trillion stimulus bill. So that'll put further pressure on the fiscal deficit. In June, the Bank of Japan raised its interest rate to 1%, a 30-year high, and remains hawkish. And the economy, according to this Tankan survey, is currently quite strong. But, that's a relative term. So interest rates are expected to rise in the coming year, but we question about how much further those can rise. So, and finally, worries about fiscal sustainability? Question mark. On that point, Japan has a lot of debt. Its gross debts are huge compared to every other country. And since the start of the year, and Sanai Takeichi's stimulus bill, you have seen a big rise in bond yields.
Keith, we talk about momentum in equity markets. Presumably, there's also an impact here of momentum trading in bond markets, that it isn't fundamentals. There's also, you look at those charts of 10-year and 30-year bond yields, that's
Yeah,
extraordinary momentum trade to jump on.
yeah, absolutely. There's confidence, isn't it? Confidence drains out. And those higher yields, you'd think, well, they might attract buyers. Well, in June, they didn't. So June, foreign investors were selling Japanese bonds. The rise in yields in Japan since the start of the Iran war have been higher than in any other country. Now, Japan obviously imports most of its energy, and so you'd expect the inflation hit to Japan from rising oil prices to be higher. But is that also confidence in Japan draining away? And that sell-off in Japanese bonds has come despite continued QE, although the pace of Bank of Japan JGB purchases has slowed. So Japanese bond yields have been falling, but they are still being supported by the Bank of Japan. If the Bank of Japan were to stop bond purchases, presumably you'd see a spike even higher. Now, this is a chart from Robin Brooks. You'd expect, so on the x-axis, you've got gross government debt to GDP. On the y-axis, you've got the 30-year bond yield. And you can see there's, you'd say a regression line is, diagonally at about 30 degrees up through there. And Japan has very low yields compared to its international peers for its huge gross debt. Now, we'll talk about this in a sec, but net debt is lower. But even then, its bond yields are low. So this chart would suggest the bond yields have further to rise. But the Japanese government, we'll get onto this, also has massive financial assets. And so net debt is on the y-axis. Its net debt is around, what's that, 140% of GDP, much less than 230. Now, I question how much you can actually use a lot of its financial assets. We'll get onto that in a second. The good news for Japan is that most of its borrowings are 2-year, 5-year, 10-year. The rise in the 30-year and more looks dramatic, but has actually very little effect on its finances because it doesn't have that much issuance at that level. So you'd think that rising 30-year yields from 0% to 4% would have knock-on effects on the average interest rate paid on the Japanese debt stock. Well, actually, it won't. But still, we know that 25% of the budget is already being paid on interest. And as interest rates and bond yields are rising, so the pressure will be upwards. So the fiscal outlook, Japanese fiscal deficit is out of control. It spends 1.6 yen for every yen it takes in as tax revenue. So the red line is tax revenue. The blue line is expenditure. There is a huge gap between the two. And around 25% of government expenditure is financed by bond sales. So hence, every year, the stock of its standing debt is rising by 25% of the budget. Enormous. And declining demographics mean that the fiscal deficit will continue to get worse. These are all figures, by the way, from the Ministry of Finance in Japan about how unsustainable the Japanese budget is. And so on the x-axis, you have the national burden rate, i.e. tax as a percentage of GDP. And on the y-axis, you have social security expenditure. And so Japanese social security expenditure is already very high by international standards, and it's going to get much worse. And so that is only sustainable if there's a big increase in the tax rate, which would be very bad for GDP growth. And so this is the increase in tax rates on the um, x-axis, and social security expenditure on the y-axis over time. So higher social security expenditure has already meant higher taxes, and that's going to get worse in the next few years. Now, actually, you'd be surprised by this, but the primary balance in Japan is actually not too bad. It's about, what's that, 2.5% of GDP? And the tax burden, so the outstanding debt burden, is it will actually fall in the coming years because of the surge in inflation post-COVID and low nominal interest rates. So on this chart, we've got nominal GDP growth, which surged after COVID, and dark blue green bars are the interest rate on its bonds. So very low rates on its bonds mean that the value of the outstanding debt has been eroded. All these numbers from BNP Paribas. So essentially, that means that debt to GDP has been falling in recent years and will continue to fall for the next couple of years before rising again. So inflation has actually been good for the Japanese debt burden. But
it also means that you're sort of putting off the evil day of having to deal with it for a couple more years. The noose
yes,
is been slightly loosened.
yeah. But your fundamental problem is this. You've
Yeah.
got rising social security expenditure, but the tax base is shrinking and shrinking steadily. And these are not small numbers. This is population decline rather than worker decline.
There
But
may be some offset via inheritance taxes, Keith.
yeah, but I was thinking about this, Stuart. You surely, I was thinking about the stock of money. Yeah, if you because we know the money supply keeps on increasing. Yeah,
Hmm.
so but even if your stock of money were not to increase, was just to remain stable, and let's say the population falls by 20%, doesn't that mean the stock of money per person must rise by 25%? And isn't that inflationary? Question.
Uh, so I was just thinking literally about the Japanese inheritance tax rates, which are very high. So that stock of money wouldn't necessarily fall to the next generation. You'd be paying 40, 50% inheritance taxes and the government getting some of that money stock, which it could be prudent with.
Yeah, now if they were to cancel debt, you're right, but that would mean the stock of money, the money supply, would
Before.
fall
Mm.
as people paid inheritance taxes, and it isn't. Um, Meanwhile, falling birth rates as we've seen, and in 2025, birth rates were their lowest since records began. Not great. So, bottom line is that actually, in the next few years, Japanese debt to GDP will fall to bottom about 225% of GDP. But those forecasts were made before the latest 2.3 trillion stimulus package. We haven't had an update yet. But in the medium term, Japan definitely faces a debt sustainability crisis because it refuses to consolidate its fiscal budget. Instead, it keeps on doing stimulus. It's got rising interest payments and a declining tax base, but it also has enormous financial assets. So we talked previously about how its net debt was much lower than its gross debt. So the Bank of Japan has 1.4 trillion, as we discussed earlier, mainly held in US treasuries and other foreign bonds, but also the GPIF, the government pension fund, has 900 billion of foreign assets out of a total of 1.8 trillion in total assets. The private sector also has big foreign assets. The banks had hundreds of billions, insurance companies similar, corporations similar, and even households have net foreign assets in the tune of low hundreds of billions. Now, in theory, those foreign investments could be sold to cut debt and support the yen. But private foreign investments would not be repatriated. They would only be repatriated by citizens and corporations when they see the investment opportunities in Japan being better than elsewhere. But the other thing to say is that Japanese debts are denominated in yen. And so a falling yen has massively improved the net financial position of Japan because moving assets, its foreign assets obviously have retained their value in US dollar terms, or if they're bought Nvidia, they've gone up massively. And then you repatriate the money and buy yen, which has depreciated by what, 50% in the last 10 years? Essentially, you could look at it as the Japanese establishment have been operating a hedge fund in which they have been borrowing cheap yen at subsidized rates so that, the rate you get from Japan Post Bank is very low. And they've been using that money to invest overseas in higher yielding assets. So the Japanese government also has its own foreign assets, and you're looking on the left here. So cash of 65 billion, but also securities, foreign currency securities, 142 billion, etc. Pause, have a read. The FT did a whole article on this, and they conclude that if you include all Japanese public sector assets, its net debt position is only 119% of GDP, i.e., the same as the US's. And it's actually been making very good money from its interventions in the yen. Apparently, over the last 5 years, it's made about 200 billion. There you go. So, and the numbers we include are not marked to market. If you were to mark the Bank of Japan's ETF portfolio to market, then the value would rise by an astonishing 11% of GDP. So it's made fantastic returns on its foreign assets. So as Japan runs like a sort of sovereign wealth fund, borrowing citizens of it, the money of its own citizens at subsidized rates. As a result, Japan's net liability position has halved since 2020. So, when you include its assets, its finances have actually been improving, mainly because of the AI bubble and its overseas investments. And households also have huge assets which they could use to pay down, well, could be used to pay down the debt. So Japan is a rich country. And part of the reason it's been acquiring foreign assets is it runs a consistent foreign account surplus. So it's always getting foreign currency, which gets used to buy foreign financial assets. But I question whether that is much help. So as long as there's a yield differential between JGBs and US Treasuries, there will be a constant flow out of the yen to fuel the carry trade and by, frankly, domestic investors searching for better yields. That's exactly what Japan Post Bank is doing, frankly. In order for those assets to be any help, they must be sold and converted back into a flow into Japanese yen to cut the debt burden. And there's just little prospect of that actually happening. If it were to do so, then the yen would rise sharply and global equity markets may sell off as it struggled to absorb the selling from Japan's huge ETF and equity holdings.
So the other issue here is which I've never got totally clear in my head, is that these assets that, for instance, the government pension investment fund has, well, okay, say you've sold them to reduce Japanese government debt. Well, we've still got to pay the pensions that pension fund was there for.
Yes, I
So
totally agree.
it's not sort of ready money available. It's sort of, as you said, it's a hedge fund position which has worked very well. for reducing the pension fund's liability, but it's not really there in terms of ability to reduce outstanding debt.
If you were to sell all those assets, you would still have a big liability to your pensioners. So,
Right, exactly. But irrespective of any market moves that it caused in the short term, the overall balance sheet position seems to me doesn't really change.
yeah. Okay, so given the sell-off in the yen and the sell-off in Japanese bonds, is Japan actually already in a quiet financial crisis? Because those are emerging market debt dynamics. Rising yields are not supporting the currency. This is how the markets think a Japanese debt crisis might unfold. Bond yields keep rising, yen keeps falling. Falling yen means rising inflation, which means that Japanese bonds continue to sell off and forcing the Bank of Japan to raise rates, which would slow the economy. The budget deficit would therefore continue to widen, in part because its interest burden is also rising. So you have further deterioration in the fiscal situation. Investors lose faith in JGBs, stop buying them, bond yields spike. And essentially, the Bank of Japan has no way to halt the rise in JGB yields apart from raising interest rates, which damages the economy, worsening the fiscal balance. Essentially, this is the way all emerging market debt crises result. If you think of Britain leading the ERM, we attempted to defend the currency by raising interest rates to 15%, but where that had no credibility. And so the currency sold off anyway, because Britain couldn't support interest rates of 15%. So at some point, raising interest rates does not defend the currency. The only resolution would be crisis, debt restructuring, and fiscal consolidation. So you would need to actually cut pension payments, etc. You only get there via the IMF, I would think. Now, the thing is, I'm skeptical, actually. I don't think we're there yet. So Japanese bond yields remain well covered. The last 30-year auction had a bid to cover ratio of 4. And I think bond yields are rising because they're converging on global norms as the Bank of Japan steps back from its QE purchases. They're not at a premium yet. Investors are not charging a premium to lend to Japan over the US, unlike in the UK. And as we've said, rising long bond yields have very little effect on the budget because Japan mainly borrows short. And higher inflation actually means that Japanese debt burden in gross terms will actually fall in the coming years. And we've seen previously that Bank of Japan can increase QE to reduce yields if it so wishes. Potentially, at the side effect would be higher inflation, perhaps, but that's not what happened previously, and a weaker yen. But weaker yen is actually good for its exporters. Japanese inflation remains under control, 1.4% core, and is not facing a funding crisis. Households have loads of financial assets. If bond yields were to rise enough to be attractive, then you'd see money funneled out of deposit accounts into savings accounts or longer dated funds, which would go into JGBs. So how I think Japanese fiscal crisis might unfold, essentially, it all depends on confidence because the Japanese have actually loads of financial assets. And so what you need to see is a domestic buyer's strike. Japanese yields continue to rise and both foreign investors and domestic investors step back and they lose confidence in the currency as fears over the fiscal sustainability and how they'll pay back the debts. At that point, when you see money starting to come out of bank accounts because people are worried about the value of the currency, then everything goes, you get an accelerating crisis. But I think we're just a long way from that. I just think currently what we're seeing is, you know, the carry trade and a normalization of bond yields as Japan steps back from QE, sorry. But me long term, I'd be interested in Stuart's thoughts on this. I see no way out for Japan in that fiscal situation continues to deteriorate and will deteriorate basically under all scenarios unless you get a massive increase in productivity, which there's no sign of. Yeah, Stuart, your thoughts?
Well, I think I've used this line before, but I always remember a quote from a guy at the IMF who said there's four different types of country in the world. There's developed markets, there's emerging markets, there's Argentina, and there's Japan. Um, this situation has been evident for a long time, but it just keeps persisting. You are, in that sense, drawing on fat, aren't you? The wealth of the country, and in a sense, the trick of the hedge fund like exposure of the overall asset and liability position has protected Japan and has sort of smoothed the losses from the bubble, which we didn't really cover. That's the, in the sense,
Yeah.
the origin story of, well, that and the demographics, the origin story of the problem. So I think you're absolutely right, but about the structural position, but you're also right that we can't say when. Confidence is a totally unpredictable thing, and there's existing buffers which haven't been fully drawn down yet. So I don't like having a large position in Japanese assets because of this sort of earthquake risk. Sorry,
Mm.
I don't mean literal, obviously a financial earthquake. And it's rather, worrying that Japan has not really stepped up to the competition from China in terms of its manufacturing base, because as you say, productivity would be one solution here, but there isn't a big venture capital industry in Japan. The protection of workers is strong. Well, in some industries, is very strong compared to China, which can allocate its resources very quickly. And you've seen a lot more innovation from China than you have from Japan, for instance, and a lack of focus in China on making money and more on taking market share, which further sort of tightens the noose on Japan. So it's a sort of boiling frog problem, isn't it? We don't know when it's going to reach a tipping point, but you don't want to be too close to the action.
When we talk about the future fiscal path of Japan, because interest rates are higher, then its debt service costs were forecast to keep on rising. So at some stage, Japan is going to face a big crisis. These bubbles are forecast for 2036. So in 10 years' time, basically, you'd see a huge rise in the debt servicing costs. So what is the outlook for the yen? Interested in your thoughts, but to me, what was the sign of a crisis would be disorderly rises in the yen and JGBs, and we're not seeing that. We're seeing orderly rises, and that I think is just a function of the carry trade. As long as there's differential, you can borrow very cheaply in yen, and you can then invest in US Treasuries at a much higher yield. There'll always be an incentive to do so and to increase the size of the carry trade. It will be so you'll see a steady flow out of the yen. So I can't see any reason why the yen would keep on falling as long as people will continue to borrow. When you get pullbacks in borrowing, you'd get the yen um, strengthening very sharply. And for JGBs, I think yields just keep on rising until they reach global market norms. If they keep rising further, then I think you can say we're in a crisis of some kind. until that point, I don't think you can. I think you can just say we're normalizing. So potential trades, and this is something I've done. I've increased my position in the IJPH, which is the iShares MSCI Japanese Equity GBP hedged ETF. So the idea here is that the yen continues to weaken. That is good for Japanese company with strong earnings. And so the topics continues to rise because the yen keeps on weakening, but you're hedged. So it's a way of playing a weak yen. Or you could short JGBs on a spread bet, or you could short the yen on a spread bet. And none of which we would, encourage, frankly. But Stuart, any thoughts?
You're a braver man than me, given the valuation of the yen, to be hedging it back to pounds from this level. Uh, what exposure I do have to Japan, I have via a couple of UK investment trusts that are picking up on a different theme, which is the attempt by the government to improve corporate governance standards, which is leading to much more shareholder-friendly actions from a number of medium and smaller companies in Japan. So that gives it a sort of differentiated bet. It's not really driven by these macro points. It's more about final attention to profitability and then shareholder value in Japan. So just thinking through the mechanics, if you've got a pound hedged ETF and say the yen were to strengthen, you'd have a double loss, would you not? You'd have a loss in the currency and likely the equity market would be weak at the same time.
Well, you'd have no loss on the currency, Stuart. That's the point. Because the currency is hedged. So all you lose is the change in the topics.
Yeah, sorry, I'm being slow. Yeah, yeah.
So what is SimonW's technical analysis of the yen and topics? Because frankly, we've just concluded that we don't think they're going to be rising exponentially. And he thinks that the topics is just in an uptrend,
But
rising.
rising at 28% per annum, it
Yeah,
tells you
exactly.
something.
Yeah, exactly.
Yeah.
Which seems like, but there are structural reasons for that as well. I mean, the people have been talking, and you were talking about how corporate Japan finally seems to be getting its act together and becoming more investor friendly, and corporate governance is being becoming more American, and all of which is good for shareholders. So there are reasons that the fundamentals of the Japanese stock market are improving, as well as the yen's weakening. And currently, the trend is up. Play the trend. Meanwhile, the yen has broken out of its last support level, and it may be cheap, but it seems to be heading higher. And that also should be good for the topics. Well, the two are clearly related, frankly. So, I mean, frankly, I haven't got a huge position in this, but it's also a hedge against, at some stage, I think the way this eventually will play out is Japan can suppress its bond yields through QE or whatever, but it can't suppress it, can't control its currency.
Yeah,
And
yeah, it's that trilemma problem.
yeah, that's right. So any crisis will show up in a falling currency, and the flip side of falling currency will be higher inflation, higher equities. You think Weimar Republic.
Hmm.
Great. Okay. Thanks, Stuart. And now on to the macro data. So, quick summary. Well, UK stagnation or stagflation, it depends on what oil prices do, frankly, and what the knock-on effect for inflation is. So, if you asked me last week, I would have said stagnation because inflation was coming back down. But now oil prices coming back up. So it's one of the two. But anyway, GDP growth is weak. EU similar. US doing just fine. Actually, strong nominal GDP growth because inflation in the US is higher than it is in Europe and the UK. So onto the UK, GDP growth was revised down to 1.9%. So GDP growth in Q1 was revised down to 0.9%. Business investment was very disappointing, minus 1.3% year on year. So I stated earlier that the UK is not participating in the global AI investment boom. Well, according to ChatGPT, the Department of Trade and Industry has stated that UK investment in AI is 44 billion over the past year, which is 1.4% of GDP. And I just don't believe that, which is 3 times that of France. So according to the UK government, UK is participating in the AI boom, but I suspect that's just pledges rather than actual spending. This is Bank of England consumer credit, absolutely fine. Mortgage lending fell sharply in May. That's probably war related, which meant total consumer credit also fell in May. Let's see what the bounce back in June. Money supply growth in May was only 0.1% month on month, lower than expectations because consumer credit was low. Construction PMI remains absolutely terrible in June at 38.4, well below 50, which is the border of expansion and contraction. Nationwide house prices were 0% month on month in June, 2.2% year on year. So below inflation. And that means that in real terms, UK property prices are actually down quite a lot over the last 4 or 5 years. Indeed, job postings are going nowhere. Charts related to the UK. Well, this is the costs of the UK capacity market. And you'll see in the coming years, they will keep on rising. And that means your electricity bill is going to keep on rising because we need to put in new transmission lines from Scotland to the south, etc. So this chart shows the effect of the various infrastructure expenses on your electricity bill over the next 5 years. So assuming that the wholesale cost of electricity is constant, so gas prices, etc., don't rise, then your electricity bill will keep on rising despite flat wholesale costs because of increased network costs. Generation subsidies actually fall. So here we are. This is a breakdown. And pause, take a look. What's interesting is renewable obligation certificates fall very sharply over the next 5 years. So they were incentive schemes for the first renewable schemes, and they expire. So that will drop from £102 a household in 2025 to just 17 in 2030. But that fall will be more than offset in rises absolutely everywhere. So look at grid rebalancing. It goes from 41 to 91. Distribution rising, transmission rising. So subsidies and other costs will be an increasing part of your bill going forward. When we look at price changes in the UK over the past 25 years, electricity at the top up 425%, higher than everything else. This chart was meant to show, regulated prices, which have been rising very sharply, versus unregulated. Actually, it's probably domestic prices versus imports. Imported price stuff has become much cheaper. Stuff we make at home, much more expensive. Reminder, Andy Burnham is now, according to the FT this morning, suggesting a bumper budget in the autumn. And even before he adds some taxes, the UK tax burden is forecast to increase to a post-war high within this parliament. But tax on the average worker is below the ECB average because successive governments have basically added taxes on the wealthy and cut them for the average worker. Andy Burnham is likely to increase taxes on a stagnating private sector to spend them on an increasing government sector. As a taster of things to come, Burnham is proposing a warehouse tax. The complexity of the UK tax code is already out of control. It's only going to get worse. And this is a depressing chart showing UK temperature relentlessly rising and the heat waves sending it way, way above trend. That's only going to get worse. So quick summary, not much data really. Stagnation or stagflation, depending on how the Iran war goes, but really very disappointing growth. And Andy Burnham is going to add both taxes and red tape. Okay, I've prepared something on the OBR fiscal risks and sustainability report, but we're already over time. I'll do that next time. And onto the EU. So flash CPI for June actually down as with falling oil prices, and it's very good. Below expectations at 2.8%. So no secondary effects, core at 2.4. Good. PPI, not great, rising at 5.9% in May. And reminder, we think there's a 1 month lag between producer price inputs and their effect on inflation itself. So this should be reflected in the June numbers we've just reported. Retail sales, very disappointing, 1.6% year on year, so weak. Economic sentiment, 95, so below 100, a bit better than last month. As the war ended, well, that's going to reverse. Industrial sentiment, still negative. Services sentiment, very weak, but a bit better. Well, again, that's likely to unwind. Loans to companies growing a decent lick, actually at 4% and improving. Loans to households, 3.1%, again improving, but still below pre-pandemic levels. Money supply growing at 3.2% per annum. Consumer inflation expectations for May coming down. That's good news. Unemployment rate at its lows. Construction PMI just terrible. Even worse than the UK. D job posting in Germany still deteriorating. In France, stabilized a bit over the past couple of weeks, but the trend is definitely down. This is a really good chart of German industrial production. You think that Britain deindustrialized post-war. Well, Germany is deindustrializing now. Not good. So, in summary, not much data. Good news is that EU inflation came down in June and there's no sign of secondary effects. So, will the ECB be raising rates as much as the market assumes? Stagnation. Or if we're prolonged war, stagflation. On to the US. So, Q1 GDP upgraded to 2.1%. The US economy doing just fine. JOLTS job openings actually bounced a bit, but JOLTS appears to be more optimistic on US job openings than other indices. Other indices show the markets are stabilizing rather than improving. And the rest of the JOLTS survey was less encouraging. Hiring was down, that's the dark blue line. Layoffs were layoffs were up a bit, that's the grey line, and quit rate was down a bit. Rising job openings should translate into falling unemployment as per the Beveridge curve, and that is what we are seeing. So non-farm payrolls for June were disappointing and the May number was revised down. So this suggests actually after a surge in March, the US jobs market is weakening again. And The numbers for April and May were revised down a total of 74,000. Meanwhile, the household survey reported a net fall in employment of 507,000, and the two lines are now diverging once again. And that weakness appears to be caused by a weak informal sector, which is not included in non-farm payrolls. So non-farm payrolls um, surveys companies and larger companies, and the soft survey data suggests the job market is weaker than the headline numbers suggest. So that is, employment surveys asking people whether they've got a job or not. Employers remain reluctant to hire. And I thought this was really interesting. The labour force participation rate for people um, with less than a high school diploma has collapsed. That is the sort of thing you only see during a recession, frankly. Odd. Is that the ICE raids keeping immigrants at home afraid to go out? Question mark. Residential building payrolls are starting to roll over, and reminder, in a normal cycle, excluding AI investment and construction, that is a real harbinger of a coming recession. Cyclical downturn in construction employment. Average weekly earnings, 3.5%, slowly drifting down, and perfectly compatible with 2% target, given decent US productivity. Unemployment rate ticking down, U6 also ticking down. But that's because the participation rate is falling. So people are leaving the labour force, causing the unemployment rates to come down. The AFP employment change, that's a survey of employers, shows decent employment growth, weakness last year, but economy recovering this year. Challenger job cuts falling, actually a pretty normal level, so no sign of a pickup in layoffs. Construction spending weak. That's interesting. So falling residential investment is not being offset by AI construction. ISM manufacturing weakened slightly to 53.3, still in expansion. Services 54 down, but that's still a good number. But compared to pre-pandemic, that's actually a bit weakish. RCM TIPP Economic Optimism Index for July. That's a survey of consumers, bounced up, and this was before oil prices started rising again. Conference Board consumer confidence fading, but been a very poor guide to anything, frankly. Case Shiller, couple of strong months, but year on year at 1.1%. So real US house prices falling. Initial jobless claims normal. Continuing jobless claims actually low. So no sign of pickup in unemployment from jobless claims. GD job postings stable but going nowhere. Showing that, so unlike JOLTS, showing that the labour market is stabilising, not recovering. Into the nowcast, Dallas Fed 3.2, Atlanta Fed 1.3%. Now, if you look into this, it's not because the Atlanta Fed thinks the US economy is slowing. It's because it thinks that imports are rising. New York Fed GDP nowcasts 2.74% and very stable. St. Louis Fed 1.5%. Lantern Daily Index net strengthened a bit over the past couple of weeks and fine. Trueflation quiescent. But the US economy is a big bet on AI. So tech-related expenditure has shot up in the past couple of years. Excluding that, other investment has fallen. So when tech investment declines, the US economy could be in trouble. And when you look at private tech investment, it's been relentlessly rising for the past like 25 years, 35 years. It's now 7% of GDP. Credit card delinquencies are high and still rising, close to all-time highs. So K-shaped recovery, poor US consumers not doing very well. And Trump administration has proposed a 1.5 trillion defense budget for 2027, a basic budget of 1.15 trillion, and that's a new high, keeps on growing, plus an additional 350 billion in reconciliation funding. So Congress has apparently there's broad support for the base budget of 1.15 trillion, but the extra 350 billion is contested. So pressure on US fiscal spending is upwards. No, nobody is talking fiscal prudence and cutting the budget deficit. Pause, take a read, but frankly, the US economy is doing just fine. And finally, SimonW's technical analysis. So SpaceX looks weak, and with lock-ins starting to expire end of July, lots of stock will become available, and it would seem that the trend is down, and we think the fundamentals are down. Now, this is interesting. Brent, Simon's saying that the trend pre the war in Iran was downwards, and if the Straits reopen, that downward trend will reassert itself. So, in the meantime, Brent is prey to unpredictable geopolitical forces. So the technicals are down, but I think that the Straits are not going to reopen soon. And short term, the pressure on Brent is upwards. But at some stage, you'll need to get out. The semiconductor index, SOX, looks overextended. Is that a blow off top? I think it is, but then we thought that before and it's kept on going. I think this time's different. For everything is decelerating. Trends are changing. So I think we're in a period of heightened volatility before. All of this froth comes out of the market, so be prepared. S&P 500, however, Simon thinks the trend is still intact. Reminder, we were talking last week about how Jeremy Grantham said that one of the signs of a market topping is a change in leadership. So the stocks that have been driving the market higher start to underperform. And then for 6 months or so, the rest of the market continues to go up before they all start to come down. And Simon's saying the trend in the S&P 500 still remains upwards. Credo Technology, which I bought earlier on Simon's technical analysis, is in a period of consolidation. And finally, on to good news. So, Japanese scientists have been looking at the gut bacteria of various amphibian species, reptile species, because they'd previously found that gut bacteria have good anti-cancer properties. So they isolated bacterial strains from the intestines of Japanese tree frogs, firebelly newts, and grass lizards, and then screened them for anti-tumor effects. And they discovered one which has very strong anti-cancer effects, in part by boosting your own immune system. And so when they injected mice with E. americana, which is this bacterial strain, they achieved 100% response rate for colorectal cancer. They completely eliminated the tumors, and they're now moving on to looking at other cancers. So there you go. Great news for potentially for cancer, but also for biodiversity. We need it. So concluding comments. Actually, no change from last week. He gets one right. The Iran war was not over. We didn't think the oil market would return to normal, and it's not. I expect basically we're now in a cycle where Iran wants to assert its control over the Straits. The US wants it to stop doing that and is going to have to be resolved one way or the other. In the meantime, Iran will try and continue negotiations to stop the US from bombing it, while also attempting to keep the Straits closed and spinning Trump a line about hardliners being out of control, etc. And I think we're in a topping formation before this bubble eventually bursts. Okay, that's it. Super long episode this week as we were talking about Japan. The next episode will be in 3 weeks' time as I have another hiking trip coming up. In the meantime, thank you all very much for watching and continuing to support the podcast. Please can you press like and all the rest of the stuff, and enjoy the summer as temperatures cool down. Thank you to Stuart Owen, who has had to go, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.